All right, spotting consolidations and trends. And they go, of course, hand in hand. So that's why we need to learn about both. This is arguably one of the most important videos in the whole spring enrollment, I would argue. Now, this deserved a video alone in the analyst month or the execution month, but we decided to put it in the finishing touch month right here. And the reason why it's so important is because the better trader and the best trader is going to be able to spot the opposing conditions as early as possible. And what I mean by that is a good trending trader and a profitable trending trader can spot consolidations as early as possible and can stay out of them, can know this is low probability because we have signs of consolidations. Good consolidations traders can spot trending conditions very early on because they know, okay, this is low probability for me and this is what I want to stay out of. Now, most of us in the MMT are trending traders. So we want to find the best trends, and inside those trends we have different trends, but we also have a step-by-step process to understand how we can see a trend form and we can slowly start to see consolidating price action and we get the signs. And that is very important to understand because, again, making money in trending conditions, that's not the hardest part. It's keeping it in low probability conditions like consolidations. That is the hardest part. So when we can spot consolidations as early as possible, that's when we are the most profitable. That's when we are at our best, essentially. So again, like I mentioned, arguably one of the most important videos in the whole spring enrollment because this is eventually what it comes down to. All right, now, how can we spot a consolidation? How can we spot a trend? Well, let's first go over what is a trend. So I've just drawn a beautiful stick higher right there. That will make a lot more sense later on as well. A trend is one-sided price action, where we also have order flow essentially building up. One side that's stronger. So we now have a bullish trend right here, where we understand this bullish side is really strong. The bullish intention is there. Bullish price action is pushing price higher and higher and higher because the bullish side is really strong. The bearish side doesn't have anything to say. So we could argue with this trend that we are looking at, we have 100% bullish price action right there because we are really having bullish intention and 0% bearish. Okay, when we understand what a simple trend like this is, then we can move on. We can move on to what is a consolidation. A consolidation is the opposite of a trend right here. So this is a consolidation where we have moves higher, moves lower again, moves higher and lower, where we don't really move. We stay in the same place. We stay in ranging conditions. That means neither side is strong enough. So in the previous example, where what is a trend, we have one side that's really strong. The bullish side is stronger, way stronger than the bearish side. But in a consolidation, you have the bullish side being strong, then you have the bearish side also somewhat being strong. So neither side is strong enough to push price higher or push price lower right there. Now that's very important to understand because the difference between a consolidation and trending conditions leads to the understanding of what's a good trend, what are signs that we want to consolidate. What does that mean? Well, right here, what is in between a consolidation and a trend? So here we have the two extremes. We just talked about a consolidation right there where neither side is strong enough. You could argue both sides are equally as weak or equally as strong. There's no clear trend. Then we also have one other side of the extreme where we have number 5 right there, a clear trend. That's what we talked about in what is a trend. We can define these different trends and we have things in between that consolidation and the trend. So we have things in between the overall two extremes, which is also known as, for example, the arguments that we use, the probabilities. Because if we have a really high probability trend, then we have one side of the extreme right there. If we have 50-50 price action, then we'll most likely have a consolidation right there. So they also go hand in hand with understanding those probabilities, those arguments that we create in a chart. Now, what are these different trends? And again, what is in between a consolidation and a trend? Number 1, we have a consolidation. Well, let's actually start at number 5 because I think it's easier to understand when we start on the other side. Number 5, we have a breakaway gap trend. So a back trend right there. Meaning we move higher, but we leave behind breakaway gaps, indicating that the bullish side is so strong, the bearish side does not even have any strength left to create a retracement. And that's when we create a breakaway gap trend. Okay, then we have number 4 right there. We have an FVG trend right there. And an FVG trend is where the bullish side is still extremely strong, but the bearish side also has something to say. That is why we create the small retracements back into fair value gaps and sting into those fair value gaps to then continue higher. If the bullish side was even stronger, we wouldn't have those retracements into fair value gaps, because then we would only create breakaway gaps right there. So understanding the difference, they might seem the same, but it's not the same trend. That's very important to understand, because those are signs that we can use to then understand that we are getting closer to a potential consolidation. So we have this fair value gap trend again, where we could argue, okay, let's put it this way. We are 90% bullish right there, 10% bearish, because that's why we created a retracement. Otherwise, we would be 0% bearish. And when we are 0% bearish, we create a breakaway gap trend right there. Perfect. We have a fair value area trend right there. And what is this fair value area trend? Well, here we are retracing back into fair value areas. So can you see now the trend that's going on, this the cycle that's going on? We now have less retracement in the breakaway gap, a little bit more retracement in the fair value gap trend. Then we have a bit more, even more retracement in the fair value area trend right there, where we could argue we're still 80% bullish, but now 20% bearish right there. So we start to create deeper retracements into fair value areas right there to then continue higher. Again, the reason why that retracement is even possible is because there's strength in the bearish side. There's strength in the opposing side to the overall direction of the market. So what does that mean? We are overall bullish, yes, but without having any bearish strength in the market, we can't create retracements, so we get breakaway gaps. The more bearish strength there is in the market, we create more retracements and deeper retracements as well. Now, that leads to the understanding where if we go to number 2 right there, a consolidating trend. So a consolidating trend, think of it like this. We are consolidating, we are sweeping highs, having deep retracements into an order flow lag, for example, to then still continue higher overall and still come back above new highs. We sweep lows right there. So again, having very deep retracements to then continue higher again. Now, the only reason why that's possible is because we could argue right now we are 60% bullish, 40% bearish, because both sides, the bullish side is still stronger than the bearish side, but it's not super strong. It's not overwhelmingly stronger than the bearish side. So the bearish side is allowed to create very deep retracements, sweeping highs as well. And that's very important to understand. So the closer we get to the consolidation, the closer we get to the other side of the market as well being strong enough to create deep retracements. Deep retracements is not always a good thing, because eventually those deep retracements is what leads to a consolidating trend right there. And then it leads to number 1, a consolidation, because a consolidation is now where we are 50% bullish, 50% bearish. So we sweep highs, we sweep lows. We are not strong enough to do to follow through on one side of the market. That is exactly the opposite of a trend. And again, those different signs that we have, a fair value gap trend, a fair value area trend, the deeper retracement right there, consolidating trend, even deeper retracement, consolidation, 50-50 right there. Those are the different signs that we can understand. Okay, when we start to create a fair value area trend, we don't want to see too deep of a retracement all the time, because that might lead us to understand that we can get a consolidating trend. And when we have a consolidating trend, we are on the edge of having a consolidation as well. And those are the exact signs of how we can understand a consolidation and a trend, and how we can get early signs of the switch between a clear trend and a consolidation. Hopefully that makes sense. And I'll show you examples later on as well. All right. So how do you then know which conditions we are in? Well, that is, like we already mentioned as well, that is known through certain signs. So when we have a breakaway gap trend right here, and we don't even create retracements or anything, what are simple signs that can lead us to the understanding of, okay, we have a clear breakaway gap trend and there's no signs of consolidation right now? Well, breakaway gap, it's already in the name, breakaway gaps right there are created. So we create very strong fair value gaps, very clear breakaway gaps that we actually want to continue higher, for example. There is no rejections off of resistance. So premium rates that we have towards the left, we just blast through them. We don't do anything. So that could again be a breakaway gap trend right there. Then also another sign when we talk about swing points is running highs. So we are constantly creating those breakaway gaps overlapping with swing highs that we ran to the left right there. There's no signs of slowing down at that moment in time. And that is exactly what then creates a breakaway gap trend. Now, what is a sign that we might want to retrace a little bit deeper? That is the following, where we now have an FVG trend, so a fair value gap trend. So FVGs stings, meaning that we only get fair value gap stings into those fair value gaps, so a small wick into those fair value gaps to then continue higher again. We don't get deep retracements. The fair value gaps alone are enough to sting into it to then already continue higher. So off of those fair value gaps, you will notice we get a perfect two candle rejection, where the first candle can already be a rejection or the second candle sweeps it to then continue higher. But even in that, understanding the two candle rejection, if the first candle is not a rejection, then what does that tell us? Well, if the first candle is not a rejection and we need to sweep the previous candle low to then continue higher, that tells us it took us one candle longer to actually continue higher, to continue trending conditions. Meaning that we are weaker than if we were to continue higher of the first candle alone. That's very important to understand. So these signs, they are in front of us. They're telling us exactly what we want to do. They're telling us exactly how it's operating, etc., how strong the trend is, etc., things like that, how high probability or how close we are to consolidations. But we need to understand those signs. And those signs can be understood by retracement, by understanding how deep we retrace, by understanding our fair value gaps getting created, by two candle rejection. That is very important. So we are also running highs in a fair value gap trend right there. Now, we might get a rejection of resistance areas right there to create the fair value gap, to then sting into it, to then continue higher. That's very possible in this scenario, where breakaway gap, we didn't really have that. So let's go into the chart a little bit to understand the difference between a breakaway gap trend and a fair value gap trend right there as well. Here we are on crude oil on the daily time frame, and what we can see on this side of the market right here is that we had a very clear breakaway gap trend until we reached this high right there, that fair value area high. So again, what are the signs right here that we are creating a breakaway gap trend? Well, we have somewhat of a rejection of the fair value areas right there. We don't sting back into those fair value gaps right there. We create big breakaway gaps higher right there, and we simply reach the target quite fast. In similar fashion to what we had right here, continuing lower. Also a breakaway gap trend until we reached certain targets towards the left right there. Also a breakaway gap trend right there. Now, the more prominent those breakaway gaps are, the better a breakaway gap trend is. And what I mean by that, the more visible a breakaway gap trend is as well. So for example, here we still get rejections off of premium raise towards the left right there. This fair value area, that fair value gap as well. We still get rejections of that, meaning that when we don't even get any rejections, the breakaway gap trend right there is even stronger. So we can rely even more that those are breakaway gaps, and we can actually continue lower because we don't even get rejections off of opposing PD arrays right there. Now here we are on ES, and I want to show you a few examples of a fair value gap trend as well. So we have this fair value gap, for example, right there, which we only have a sting into to then already continue higher. And afterwards we have this fair value gap as well, which already has a little bit of a deeper retracement, right? We can also see it is indeed a fair value area that we also sting into. But it is a perfect two candle rejection. The first candle right there already is a rejection as well. We get a perfect fair value gap trend right there, where we do have more retracements than a breakaway gap trend because we actually retrace back into those fair value gaps. But there is still a perfect opportunity to get involved overall, and there's still a perfect two candle rejection, etc. Things like that, exactly things that we want to see. Now here, for example, we see a fair value gap where it's a little bit of a deep retracement, less nice two candle rejection, but we still continue higher overall right there. And then afterwards we have this fair value gap sitting right there as well. Perfect sting into it, perfect two candle rejection, and we continue higher off of that. Now here, what do we see? Here, we don't have a perfect sting into this fair value gap anymore. We have a deep retracement, an ugly 2-candle rejection right there. What could that be a sign of? That could be a sign that we are not having that fair value gap trend. We might be moving on to a fair value area trend, or even worse, we might be moving on to either lower prices or consolidating price action. And that is important to understand. So we understand the breakaway gap trend. We understand that fair value gap trend right there. And we understand when we have a fair value gap trend, it's still really good, right? It's still extremely high probability, because now we also have to find a balance in that. Where if we only create breakaway gaps, it's quite difficult to get involved, right? Because breakaway gap trends, you don't have that accuracy of a sting into a fair value gap to then get involved. So the stop loss is also more difficult. The risk management is difficult right there. So I would argue, when we talk about the two extremes, and we talk about a consolidation and a breakaway gap trend right there, the consolidation, not good. That's not where we want to get involved. The breakaway gap trend right there, also, generally speaking, not that good, because it's quite difficult to manage to get involved. Again, the draw liquidity might be quite clear, and if on a lower time frame we can get fair value gap trends and we can get fair value gaps to get involved on, perfect. But if it's all breakaway gaps, also not that nice. Then fair value gap trends, fair value area trends, they are good. They are nice, because you actually get a chance to manage to get involved right there to then continue higher, whilst there's still a clear trend as well. So it's very funny. The weaker the trend, the worse. The stronger the trend, also not that good, because we can't manage to get involved anymore. And we have a very difficult time managing our risk management, etc. Things like that. So if we then move on right here and we move on to the fair value area trend. So how do we know which conditions we are in? Well, for a fair value area trend right there, it's fair value areas are holding. We have a perfect 2-candle rejection off of those fair value areas. So where the fair value gaps, for example, if we look at this fair value area right here, the drawn trend, then we might have a fair value gap right there, a little bit above the fair value area. That does not get respected. So there is some bearish intention right there. And that leads us to overall understanding the fair value area right there. That can still lead to higher prices overall. We have a perfect 2-candle rejection off of that. Perfect. We still have a fair value area trend. So in similar fashion to what we already had, we are still running highs right there. That's quite important to understand. We still have good signs that we are indeed running highs. So fair value gaps, for example, overlapping with fair value areas sitting right there as well. That is perfect. So what is an example of a fair value area trend? Well, here on silver, we have a nice example of this fair value area sitting right there. That fair value area follows through nicely, creating a new fair value area sitting right there as well. Now, the dangerous part about a fair value area trend is at a certain moment in time, if we keep on creating that fair value area, retrace back into it, then eventually this will happen. Because that bearish side is clearly showing signs that we are quite weak as well. So if we do not get that 2-candle rejection right here perfectly anymore, and we already get, and for example, what we mentioned earlier on as well, see how this first candle right there rejects off the fair value area. See how this candle was already a down candle coming back into it. Then we had to sweep the previous candle low right there to then potentially continue higher. It's an ugly 2-candle rejection, which leads to our understanding. And this is how we got to a very understanding of, hey, this might be a consolidating trend on silver right here, or in general, just a consolidation. So a fair value area trend right there is usually what happens one time, I would argue. We come back into a fair value area right there, and then we continue higher. The second time, we could still continue higher, but be a bit more careful when you trade a second fair value area off of a previous fair value area. Because what that could indicate is as well that we are simply just not strong enough if we consistently create those retracements back into those fair value areas. And that is the essentials of a fair value area trend, where we are in both cases also running those highs right there. So there's a very clear sign that we are indeed bullish, but we have some bearish intention, because otherwise the retracement wouldn't have been that deep right there. Now, when we move from the breakaway gap trend to the fair value gap trend to the fair value area trend, the closer we get, like we mentioned, to consolidation trend. So a fair value area trend is the middleman. It's the edge of falling off to consolidation, or the edge of having really good price action. And that is where a fair value area trend is crucial, Because if we consistently offer that fair value area, like we mentioned, that's not a good sign. It's always having critical thinking in the form of, why are we even creating this retracement in the first place? It's not always to continue higher. It's also a retracement. Well, that retracement, why does that even happen? Because there's bearish intention in the first place. Otherwise, there never would be a retracement in the first place. So that means there's also some bearish intention. And that's good because it keeps you open-minded. It keeps you focused, essentially, on spotting conditions that are not good. It's very important. All right, then we have the next type trend, which is a consolidation trend. So how do we again know which conditions we are in for a consolidation trend? Well, there's a few things. Now we get ugly two-candle rejection right there. Lack of new fair value gaps, sweeping highs and lows, but still continuing higher. So there's an ugly consolidation trend. Now, if we only look at these conditions right here in the drawn trend right here, then we see as well, I tried to draw it as best as I could, and we see that swing high towards the left, this swing high, is sort of getting swept right there. We're not confidently closing above it. It happens quite often, right? Where we talk about conditions where the fair value area high is not overlapping with fair value gap. So the retracement is a little bit deeper right there into a fair value gap, for example, that we have, which is the only fair value gap if we still want to continue higher, that we can continue higher from right there. Actually, in the previous extra live stream in the spring enrollment, so that was, fake tops and fake bottoms, the extra live, we talked about this example on gold as well, for example, and we had a few examples of it. Then right here, we create a deep retracement. We again continue higher, but not confidently running those highs right there. We again create a deep retracement. Then we sweep the low right there to still continue higher. This all leads to the understanding we have ugly two-candle rejection. We have a lack of new fair value gaps. We are sweeping highs and lows, but still continuing higher. So there's still somewhat of a trend, but it's not a good trend. So let's find a few examples of this. So one example that we have right here is, of course, like we mentioned as well, on silver. But this is an early sign right here where we have two-candle rejection. We could potentially continue higher still, but it's not necessarily what we want to get involved on. So on the daily right here, we see ugly trending conditions right there. It's not nice. Now, even better examples of a consolidation trend, because I would argue this is even closer to just a current consolidation, a full consolidation, is, for example, US dollar JPY. US dollar JPY right here, the price action that we see is we are still continuing higher. So right here, we have deep retracements, ugly two-candle rejections right there. We failed to create new fair value gaps higher right there, but we are overall still bullish. This is a consolidating trend. This is a perfect example of a consolidating trend where, yes, we are still bullish, but we struggle to create new fair value gaps. We struggle to have a nice two-candle rejection. That leads to the understanding, well, yes, bullish side is in control, but it's not, it leads to a messy delivery. And what I mean by that is when I talk a lot about, we have trending conditions, and another good example of that is GBP JPY, for example, where yes, I think the drawn liquidity is quite clear, but the overall delivery towards it is just not that clear, and it's just very messy. That leads to the understanding of a consolidating trend right there. This right here is also a consolidating trend until we reach that high right there. That is very important because the delivery towards it is not nice, but we still deliver. Now, is that something we want to get involved in? Not actively, no. US dollar, Canadian dollar, for example, also very similar example. We have a drawn liquidity in the form of that low, and we deliver there, but it's not a nice trending conditions. So it creates a very messy delivery towards it, creating the lack of fair value gaps, creating ugly sweeps to then continue lower, ugly two-candle rejection, things like that. That makes a very consolidating trend. So I need you to understand this consolidating trend. This is not high probability, right? This is where we can still see, well, we still have somewhat of a trend, but it's not where we want to risk 2% and we can easily get involved, etc. No, fair value area trend and fair value gaps trends, those are the ones that we want to focus on. Breakaway gap trends as well. Yes, for example, crude oil, if we can still create fair value gaps on a lower time frame, for example, that could be interesting. But we need to understand the different trends, the different probabilities that we have as well, where this is not good because this is one wrong move away from just a full-on consolidation. Now, another example right here is, for example, Bitcoin, where Bitcoin on the 4 hour, we get some fair value gaps. Yes, we get deep retracements, ugly two-candle rejections. On the daily, we don't even create daily fair value gaps lower right there. until just currently. So from this moment, from the 22nd of June right there until about there, right there, that's 12 days essentially with no daily fair value gaps or anything. This is a trend. Yes, we can see it wants to continue lower, but it's not very convincingly. It's not where I would say, well, this is definitely where I want to get involved in. Definitely not. So that's very important to understand. Again, everything here is very important to understand. Okay, so we are again one wrong move away from creating a full-on consolidation. And what are those wrong moves? Well, the signs here, they already tell us what it wants to do, right? Because when we now have a consolidation, and how do we know we are in a consolidation, is two candle rejection not holding. So here it's just an ugly two candle rejection, but now a two candle rejection is just full on not holding in consolidation. Fair value gaps just simply not following through. So in the previous consolidating trend, we might have still somewhat of a follow through of a fair value gap with an ugly two candle rejection. Yes, it's a follow through, but it's not the best follow through. Let's put it that way, because we have maybe 4 stings into that fair value gap before we create a new fair value gap higher. And in a consolidation, we just don't hold the two candle rejection. We don't even follow through of the fair value gap right there. And we are now sweeping highs and lows and not continuing in one direction either. So it's just a full on consolidation right there. So what does that look like? So like we mentioned as well, silver right here is very close to just a full on consolidation. I would again argue that this is just a full on consolidation where we have the two candle rejection at first is nice, but afterwards it starts becoming very ugly. At this moment in time already, this is beautiful. Beautiful two candle rejection right here off the weekly fair value area. Then we sting into the fair value gap. Okay, this is odd. So what are we doing right now? Well, now we potentially continue higher again. We failed to create that fair value gap right there. And it all started with an ugly two candle rejection that we have right there that we immediately did not follow through right there. We could even argue that it started even earlier right there with this breakaway gap that we actually traded back into. So those are signs that we might want to consolidate right here. So until we start to create a clear trend, fair value area trend, fair value gap trend, we start running highs, we start having signs, perfect two candle rejection, fair value gaps following through, fair value gaps getting created even. Until we have those signs right there, we are still in a consolidation. So this is extremely low probability essentially to start looking to trade. So we can see how this goes from, for example, breakaway gap trends right there to then even fair value gap trends right there, deep retracement, fair value area trends right there, then an ugly two candle rejection. Okay, well, that might just be a sign that we are indeed consolidating. Again, when we have breakaway gaps as well, by the way, when we create breakaway gaps and we expect a breakaway gap trend as well, and we do retrace back into a breakaway gap, that's also a sign of a consolidation. That's also a sign that we do not want to continue higher, because all of a sudden, those bullish intentions are disrupted right now by a large bearish intention, which should not have happened in the first place. That's very important to understand. Now, right here, due to those signs, we now create a consolidation. And again, those signs, they just simply tell us, well, there's another side of the market that is also getting quite strong right now. So an ugly two candle rejection is just simply a sign that we have a bearish intention as well in the market, in a bullish trend overall. So when we have bullish trending conditions, any sign that we might have bearish intention as well, which is ugly two candle rejection, which is fair value gaps not following through, even bearish fair value gaps getting created, for example, those are signs that we also have the other side getting involved in the market right now. That's important. So here we are on crude oil as well. And if we take a look at this example, then first we had a few breakaway gap trends right there. Now we start to sting back into this fair value gap right here. We also have this fair value area sitting right there. Now, when we sting back into this fair value gap right here, what do we see and how can we know that this is actually showing signs that we want to consolidate? This is the area that we can continue lower off of, that fair value gap, right? So if we want to continue lower, then we can simply sting into that to continue lower, which we have perfectly right here. So up until this moment, there's nothing too wrong, right? There's nothing too crazy happening. Then after that, what do we see? Well, two candle rejection. What's a perfect two candle rejection? That we now follow through, create new fair value gaps going lower right there. We at least create a new fair value gap and we have a bearish down candle again. Perfect. We have an up candle. This is the first sign that you will get that we actually have consolidating price actions. And this, believe me, This happens so much. This is fractal, right? I'm right now doing it on the higher time frame, but if you're a flow trader, see how many times this happens on ES, on NASDAQ, during equities open, for example, where we don't follow through, and there's a clear sign of a consolidation, and we don't want to ignore that sign, because that sign is there for a reason. So here, we basically already saw this coming very early on. All this consolidation could have been avoided by just understanding this early sign that we had right there. Now afterwards, what happened? We now have a sting into a fair value area right there. So are we just sweeping highs right there to consolidate, or are we sweeping this high into the fair value area to actually continue lower off of right now and to follow through towards the lows? Well, let's ask the same questions. We have a perfect 2-candle rejection right there. We follow through with an expansion phase candle as well right there. Those are signs, disrespecting the bullish fair value gap right there, that we actually do have clear trending conditions. And it's just a matter of there's different signs right there. And that's all we need. There's different signs. And that's essentially what we want. So here, for example, we have this sweep of the high. Is that a sweep of the high to then continue lower towards the lows right there? Well, could be, but we have 2-candle rejection, which is all right. But see the difference in the candles right there. This also has the bottom at the bottom wick right there, quite a big rejection. Same for this candle right there. And then afterwards, we struggle to create fair value gaps right there. We have long wicks on both sides. Here, we only get a full, confident down candle. Not a long wick at the bottom. Not a long wick at the bottom. Not a long wick at the bottom. Those signs are in so many different variables and forms. They are in candle signs. They are in order flow. They are in candle signs to the fact long wicks, long wicks on both sides of the candle leads to the understanding, well, we might want to consolidate. On order flow, it's based on fair value gaps, 2-candle rejection now following through right there. There's so many different signs that we can go over. Exactly why I mentioned in the beginning, I believe this deserved a spot in the analyst month or the execution month, because this is exactly why it's so important to understand this. All right, let's move on to the next example. Now, a classical one is Euro GBP, where Euro GBP, you can just clearly see how we have a consolidation right there. And if you want to study something, then you can study Euro GBP right here, because it's a very clear consolidation right there. But again, if you want to study this, it's more important to study what leads to the consolidation. Everyone can say, yeah, this is a clear consolidation, of course, but it's more important, how can we know we are now getting into consolidation, and how can we know when we are getting out of that consolidation as well? So to give you an example right here, we didn't have a good 2-candle rejection where we actually followed through with down candles, etc., or even up candles until this moment in time right here. And we actually start running those lows right there towards the left. And afterwards, it's still consolidating trend, as in still an ugly trend, but we are creating fair value gaps. We have somewhat ugly 2-candle rejection afterwards, but it's still a consolidating trend. So there's improvement, because now we are moving from consolidation. Okay, consolidating trend. Can we now create a fair value area trend, for example, where we come back into these lows to then continue lower? Can we even create a fair value gap trend? Then it becomes higher probability, higher probability, higher probability. And then eventually, if it becomes a breakaway gap, it might become, again, low probability, low probability, low probability. So the signs from switching to different conditions, those are the most important part. Now, if you want to see that on Euro GBP, it goes back a lot. So if we look at this daily value gap right here, here we don't even, well, here it already started actually, because if we take a look at this, we have a sting into this value gap, which does not follow through. So we have a deeper retracement already, which shows us clearly again that we have somewhat of a bearish control. We continue higher right there, sting into this value gap, but it's an ugly 2-candle rejection. Same for everything that happens here, ugly 2-candle rejection, which leads us to the understanding already, well, these are not perfect conditions. These are already early signs that we might eventually right here want to consolidate, or provide a very difficult time to actually manage to catch a trade and get involved right there. So even if the trend still continues, it might not be a good trend to actually get involved and to actually trade, where eventually leads to consolidation. And here the signs are even more clear right there. And that's exactly what overall leads to a consolidation. So again, to emphasize on that fact, and I emphasize on a lot of things here because it's so important, to emphasize on the fact that the consolidation, yes, in hindsight, everyone can spot it. It's our goal. It's our objective to become the best traders we want to be, to spot the consolidation before it even happens. And when you are at that level, wow, you are an amazing trader. And when you are at a level that you can see a consolidation coming by having a 2-candle rejection, by an ugly 2-candle rejection, you are an amazing trader. And when the earlier you can spot those consolidations, the better it is. And again, it starts off with seeing it in hindsight, seeing consolidation before it happens, and then study the signs that led to that consolidation. And then study, okay, can I find even earlier signs? Can I find even earlier signs right there? And then you have trending, and then you come to the conclusion, like I came, you have trending conditions, you have consolidations right there, and they switch between it. All right, so then we move on to the last slide, and the last slide is again, there will be signs, very early signs, and that is the most important part to understand, because don't ignore those signs when they are there. Don't ignore a sign of a 2-candle rejection. Ask yourself, why does that happen even? Why do we get a deep retracement right here? Why do we retrace back into a breakaway gap? Can we still trade off of it? Well, yes, but if we have more confirmation again, because that leads again to the understanding of if we get more confirmation, it's higher probability again, and we can potentially still continue higher. So there are signs. There are a lot of signs. Study the signs. Study the signs on previous trades. Study the signs in current price action even, I would argue, because there's a lot of different conditions that we have as well. And when you study those signs, a whole new world will open up to you, and it will become a lot clearer on what is consolidation, how we can avoid it as well, and what are good trending conditions. Very important. All right, perfect. Thank you.